Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, head of research here at Valkyrie, and let's take a look at the midweek market update. We had a CPI print this morning in the United States at 4.0%, which was even below most of the expectations that I saw pre-CPI. Expectations were probably closer to 4.1, 4.2. In any event, we continue to see a year-over-year decline. Now, that does not necessarily mean a multi-year decline, but certainly a year-over-year decline. And depending on who you ask, depending on what the Fed may care to look at, they may break down CPI into core, super core, all sorts of different slicing and dicing. So we'll see what Powell says tomorrow at the meeting, but a declining CPI like this is less likely to bring in a hike tomorrow. I think this sort of solidifies the hawkish skip narrative, the hawkish part being they are unlikely to bring rates down anytime super soon. And I'm sure Powell will say that over and over in the meeting. This is a skip, not a pause. We may raise rates again in the future. They may skip 2 months and raise, right? Who knows? But the last thing they want to do is signal to the market, which is already at 52-week highs, the S&P, that things would continue to go higher on just speculative madness, because then you'd have people saying, okay, the Fed's done. They can only cut from here on out. So that's not what they want to do. Some places in the United States already back to that 2% target. This is from Bloomberg now, Minneapolis here at 1.8. Certainly not a majority of the surveyed cities here to that 2% target, but you can see declines percentage-wise coming down here. So we're headed in the right direction, as they say. Certainly things aren't getting worse on a year-over-year basis. And I talk about Trueflation a lot because it does a really good job, I think, at estimating a real-time CPI. And it really has not led us astray in many months, really, if ever. You know, it's ahead of CPI to the downside here because of the lagging housing data that's baked into the CPI. And the category percentages are slightly different than CPI itself. But all in all, it's a pretty good estimation, and it continues to notch lower lows here. So we're definitely, again, headed in the right direction across the board. And because of that CPI print, most likely, you had rate probabilities for a pause at this current level spike from around 70% to almost 92% there. So the markets think that it is very unlikely for Powell to come out and hike tomorrow. Like I said, the S&P is already at a 52-week high. It took out this August high. It's above the beginning of the Fed hiking cycle. I just remember the beginning of the year, even pre-March, where everyone was certain that we were in a recession and that the S&P was going lower. Sentiment just couldn't be more bearish at that time. And it certainly feels like things are tipping in a rapid succession here towards extremely bullish sentiment. That's not unusual. You typically see that in markets, but it does give me caution for continuation here with sentiment tipping. Now on RSI, which is going to be a key measure to watch, we do not have a bearish divergence just yet. You know, a great example of that is the current all-time high in 2022. You had a higher high in price and a lower high in momentum. So it's definitely something to watch for here. Now, everyone across the board is coming out saying 4,500, 4,700 now, right? Even though arguably, you know, I've been talking about the TA side of this for what feels like months, at least since this diagonal broke. And things still look like we're heading in that direction. I'm just cautious regarding a potential bearish divergence here. Definitely something to watch for. Still looks good. Unsurprisingly, the DXY turned down a little bit on the Fed being less hawkish, at least likely being less hawkish in the near term. On trend, though, things still look very good as far as technicals on the cloud. You know, if this were any other chart in a vacuum, this is exactly what you want to see on technicals for long entries or trades that expect higher highs. From a trend perspective, this looks about as ready to be birthed as you could look from a cloud perspective. So the DXY, the expectation here is still a strong DXY. Gold, this is the monthly chart. Not much has happened here. The biggest issue now is this multi-year momentum is flat. It's a massive range, right? From, 16 to 2000, but it remains bullish even though it's essentially momentumless in this monthly time frame. Eventually, I do expect higher highs to the 2200 plus level on gold, just probably not anytime soon. Moving on to digital assets, these are the stablecoin circulating supplies. We've got Tether, USDC, and then BUSD in the blue here. BUSD can only ever be redeemed. It cannot be created because the New York DFS and SEC went after BUSD, alleging improper practices, essentially. So Paxos has shut that down. This will only continue to redeem. And as long as regulatory uncertainty remains in the US, USDC is very likely to continue to diminish. I think as well offshore, individuals view USDC as very, very regulatory compliant, which is both good and bad. If you're offshore, maybe you don't want US regulatory compliance. If you're onshore, it makes sense, right? But in any event, we are seeing Tether reach new all-time highs now in circulating supply. So there's continuing of use here in Tether relative to USDC. And there are stories in emerging markets, Turkey being the chief among them, where people are using Tether as a store of value. I'd imagine that's going on in Argentina as well. So stablecoins certainly serve a purpose other than just speculation in crypto. If we look at Bitcoin on-chain activity, active addresses have recovered slightly. This is a monthly average now. Transactions still extreme multi-month highs. This is still relatively at an all-time high, still holding at that level. This was the NFT minting activity. And fees exploded, so active addresses came down. And you'll see these two metrics sort of jostle back and forth. But the NFT stuff has quieted down a little bit. If we look at that on Dune here, these are the minting inscriptions over time, and that continues to decline really since the peak, the mania in April. Now, I fully expect this to be back in some form come in actual real deal bull market. But right now, the safe havens are Bitcoin, Ethereum, and stablecoins. Anything altcoin, anything NFT, certainly not looking like a safe haven based on prices. Fees as well here, you can see, just continue to decline. Looking at the price chart, just the cloud, my favorite metric here, we continue to drift in the cloud, very turbulent. Sometimes we get lucky. Sometimes we get the BTFP situation where we go through the cloud, bounce. It's perfect, right? Other times it is a very slow drip, 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 drip. Nevertheless, there's still an expectation. Eventually we will tap the edge of the cloud here. The question is whether or not we bounce from there like we did in March. Broadly, sentiment does feel extremely bearish, but when we look under the hood, I don't have a chart for non-zero balances under here, but we continue to see purchasing, buying, suggestive of DCA. We don't see people cashing out. We don't see users giving up effectively on-chain. Looking at price a slightly different way, this time with a chart pattern lens, we've got this multi-month inverted head and shoulders that we've already broken out of as far as the resistance area, the neckline. And in our current state, we're sort of forming this falling wedge, which I talked about in the weekly piece on Monday. And I don't think it's too far off to think of a scenario where we continue to sort of bleed, just bounce, just apathetic, unexciting. Eventually we sort of meet a better support level at that breakout point. And at that point, we will probably be close to the 200-day moving average as well, this red line. So that's really where we need to start to see a reversal in price in order to not be in trouble on trend, because at that point, we'll be below the cloud and below the 200-day moving average. If that bounce is successful, then I'd expect a price target somewhere in the 30s, 31 to 35, something like that. And this could also be a pivot to pivot trade. Pivots are based on the highs and lows mathematically of the previous year, and Bitcoin has really liked to respect pivots historically. So as we're grinding lower, we still have a shot at a strong reversal rally off of this. And if we look at the weekly cloud, we're still below the weekly cloud, so there's not a lot of reasons to be bullish just yet, because again, historically, the strongest rallies have always been above the weekly cloud. So we are still ready to move through the cloud, potentially eventually, as we get closer to 2024, closer to the halving. But in the moment, there certainly isn't a super strong expectation of upside. One other thing to note here is the TK across these red and blue lines, just like 2019, 2015, and really any time on the daily, you can see it in the opposite direction in 2018, in 2022. Before you do get that actual reversal in trend, you do see a congruent TK cross. So in this case, we would be getting a bullish TK cross and potentially a move through the weekly cloud, just like we did in 2016 and then briefly 2020. So these are just things to look for well down the road on the weekly chart, but things still look very good for that potential, right? Now, if we start crushing lows and lose the BTFP low, we lose the ultimate FTX low, then it's a different story. But in the moment, things do not look half bad for bullish continuation into 2024. One other thing on the weekly to watch, to take note of, is the Bollinger Band, which, again, historically, Bitcoin has done really well as far as tipping the trend bias. So when we are above the 20-week moving average, that is a bullish trend. When we are below, we are bearish. Generally, there's been very few oscillations within that. So as we are slowly grinding below the 20-week moving average, things do look increasingly bearish here. And there is a potential for a tap of the other end of this Bollinger Band. Bollinger Bands are based on 2 standard deviations from the 20-week moving average. So that's where you see these bands get wider or tighter. As volatility contracts, the bands get tighter and let you know that, hey, a move's probably coming up. A great example of that just on the chart is July 2020, closer to October 2020. We had a very tight squeeze here on the weekly, and then we had a move. So again, this does look leaning bearish there. As far as Ethereum goes, Ethereum's got unregulatory certainty, undoubtedly, as the SEC still has been unable to come out right and say whether or not ETH is a security. Even if it is, even if it was, the SEC would likely go after Consensus or Joe Lubin or Vitalik. They'd pay fines. Maybe it would get classified as a security. Nevertheless, that uncertainty remains, and I think that's certainly hurting ETH a little bit here. ETH has seen 3.5 million in inflows towards staking into validators. Most of that has gone into Lido, but in any event, that's still 3.5 million ETH that's out of circulation effectively. So again, in a bull market, eventually you'd think the supply-demand dynamics would kick in and have a positive influence on price. Looking at on-chain activity for ETH, transaction counts have continued to decline over time, over the past 2 years really, but have flattened out. Active addresses also declining, slightly flattened out here, but nothing super exciting just yet. Not a great amount of activity going on. And on the daily cloud, we are starting to tip below the cloud here. We already had that bearish TK cross for quite some time. And ETH certainly looks more bearish than Bitcoin does. One thing to watch, just like on Bitcoin, eventually you'll get prices above the cloud again. We just haven't really seen an extended period of time other than maybe the beginning of the year where that happened. It's mostly been bearish down or bearish chop. We haven't really had a real deal bullish trend for quite some time here on ETH. And lastly, I'll just mention Total 3. So Total 3 is the market cap of everything except ETH, except Bitcoin. I've also subtracted the market cap of Tether, USDC, and wrapped Bitcoin. That still leaves a few others, stablecoins and wrapped ETH, but in any event, it gives you some clue as to what's going on in the non-Bitcoin, non-ETH territory as far as market cap. And it looks like it's ready to break the FTX lows, ready to break the year-end 2022 lows. Certainly does not look bullish in any regard here, and this is expected if there's regulatory uncertainty with altcoins, and altcoins are getting delisted in certain exchanges. Funds need to rebalance, indices need to rebalance, all sorts of activity needs to go on, retail, institutional, all across the board, where until there's solid footing, the most likely action would be selling of those coins. So it is unsurprising that you're seeing continuing contraction in the market cap of non-Bitcoin, non-ETH. So we'll see what the Fed has to say tomorrow. Most likely rate pause. We may get a positive reaction. We didn't quite get a positive reaction in Bitcoin today off of the CPI numbers. There's been some speculation that Binance may be selling Bitcoin in their coffers to prop up the BNB price. That's high speculation, but it would help justify why we've sold off, continue to sell off really, as legacy markets just continue to make highs almost every day here now. So something to watch for tomorrow would be how does legacy react, how does crypto react, and do they go in the opposite directions again? So that's all I have for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.